can start.
Good evening, the erudite speaker Pathanjali Srinivasan and the audience, both members and non-members of the Institute of Chartered Accountants of India. This is an investor awareness program that is conducted on a monthly basis, and today we have the young and dynamic speaker, Mr. Pathanjali Srinivasan, a chartered accountant, has completed his CA course in January 2020. Currently is associated with Mirabilis Investment Trust, a private family investment trust in Bengaluru. And prior to the current association, he worked with IIFL Wealth and iThought Financial Consulting LLP. And today he will be deliberating on the various aspects of investments as a measure of investment awareness program. And with this, I very warmly welcome Srinivasan to this program.
Thank you so much.
And also welcome all the attendees for this program. In view of the chairman and secretary being engaged in some other programs of SIRC, and I, the vice chairman of SIRC, Pannaraj, is here to compare the program. So with this, wish you all great learning. Good evening once again, and I hand over the proceedings to Pathanjali Srinivasan. Over to you, sir.
Yes. So thank you so much, sir. At first, I'd like to thank the Institute for giving me the opportunity. It's a very big thing for somebody like me who's very early in my career. And this is a very good rapport that we want to build, and really thankful for the opportunity, sir.
Thank you.
And just before we start to go forward to the presentation, we are mainly looking at in this presentation, we are trying to talk about IPOs, what has happened in the last 1 year. That's majorly what I'm trying to cover, because I want to give inputs on something where people can relate to what's happening. And also the data that I'm using to give the view should be very relevant for us to be able to make some decisions or understand what can be done in forthcoming IPOs that are scheduled to happen. So we can go ahead with the presentation. Yes, sir. So can you just make it slideshow mode, please?
It's in slideshow only, sir. Are you not able to see in slideshow?
No, you just need to click on the cursor on the top and
no. 1 minute. I made it in slideshow only. Sorry. Now is it in slideshow?
Yes, it's in slideshow.
Okay.
So we start now. So this calendar year 2021 is probably a year where we saw a huge amount of IPOs. So we have to give a little background as to why this year saw a lot of IPOs. Primarily, it was because the year 2020, where the first, like from early March till about June or July, the IPO market was dry because of the pandemic. So now when this happened, many companies which had previously planned to get themselves listed did not get listed. This is one thing where there was a big rush for people to try to get their companies listed. And the second thing that happened was when companies like try to get listed, they prefer a market where the market is moving in a favorable direction and there's interest in buying. So this interest in buying had started only around August 2020, and post that, a lot of companies have started filing their application for getting listed. And now here in this table, if you can note, I've taken the number of companies that have got themselves listed in the calendar year 2021. And this does not include all companies. We've put a subset of 2 criteria. One is the company should be listed on the National Stock Exchange. And when the issue has happened, the amount of money that is being raised should be over 100 crores. So that is the issue size should be at least 100 crores. So these 2 have been kept in mind because we want to look at the statistics or data for companies which are meaningful to invest. So the 63 companies that got listed, the total funds that were raised by these companies is about 1.14 lakh crores. But the interesting thing to note is that the amount of for which bids was received is about 35.3 lakh crores. So this is almost 31 times. So now why is this number very high and what is the meaning of this? In a very layman's way of understanding, like to get just 1 rupee worth of shares in a company, people were ready to like bid for 31 rupees, and in the end they would get something able to put about 1 rupee as capital into that company. So this is why this particular statistics is very strange, because there's so much liquidity in the market that is there, and people are here talking about whether we can make enough returns or not. That is one side. But look at the amount of money that's available in the public, and that tells us that despite the pandemic and all of that, there's a large set of people who still have a lot of money with them. So now this, to understand the importance of this subscription, the number of times something has got subscribed, there are about like two broad methods in which the IPOs can be classified with respect to fundraising based on the categories. One is for profit-making companies. The other is for companies which don't have a track record of 5 years at least, or if not, they're loss-making companies. This is the other category. So the qualified institutions are QIBs. It is the term that is used for the companies who are trying to invest. And these companies usually these institutions are the ones who participate in the IPO earlier than what the other categories like non-institutional buyers or retail investors or even the employees. So this the table, that is, if there are 100 shares in the company, the split between how much is to be allotted to which category is decided based on whether it's profit making or loss making. So in this particular case, if the companies are profit making, then the qualified institutional buyers are restricted to 50% of the issue size, and the non-institutional are restricted to 15%, and the retail investors, non-institutional are restricted to, retail investors are restricted to 35%, and non-institutional are restricted to 15%. So why is this being done? So in a case where companies are profitable and they have a good track record, then the regulator, which is SEBI, feels that the public can participate, and it is relatively a lower risk proposition for them to apply for this issue. On the other hand, if the companies are loss making or if they don't have a track record, then the regulator feels we have to protect the investors. So we will give retail investors who amongst these 4 categories of people have relatively the lowest amount of information about this company. So retail investors are capped at 10% of the total issue size. Non-institutional buyers are given slightly like higher risk, which is about 25%, and qualified institutional buyers are allowed to participate in up to 65% of the issue. So this is the other side of it. So in many cases, what happens is when the issues, like in this case, there are 63 companies and the amount of money that's being raised is 1.14 lakh crores. This is roughly, to do a rough math, each issue is taking say about only 2,000 crores. So 2,000 crores is a very small amount with respect to the size of the market participants. So what happens is primarily the 2 categories where the amount of money that is being managed is very high is qualified institutionals and non-institutional buyers. Because qualified institutional buyers, all your foreign investors, domestic institutional investors, which includes your insurance companies and also your mutual funds, they all participate in these in this qualified institutions. So they have a lot of capital and they are trying to deploy capital, and for them capital allocation is a bigger challenge, because they have a lot of money and they don't have too many options to invest in. So when they get good opportunities, they will go to the extent where they will bid more. and they will get a proportionate allotment. So with the qualified institutional buyers, the allotment is done on a proportionate basis. So they will bid like if they want a desired size of 2 crore position, and if they feel that the IPO is going to get the QIB portion is going to get subscribed like 100 times, then they will put in money accordingly. So they will bid for 200 crores and they will get a proportional of 2 crores as the allotment. Now the non-institutional buyers also do the same thing. The non-institutional buyers, what they do is they borrow money for applying for the IPO. So non-institutional buyers usually consist of high net worth individuals and other categories which don't fit into retail investors. So these people also again borrow money. They reverse work how much money they need to put in to get the required amount of allotment. And for them, usually because they are high net worth individuals or they have a lot more money, the borrowing cost is a lot lesser for them. And this is why many of the issues, if you notice, the QIB portion and the non-institutional buyers, the size of it becomes very, very high. And that is a little bit misleading because as an investor, we should look at whether the company that we are trying to apply in is going to do well or not and stick to the idea and then invest. Instead of that, if we look at how many times something is getting subscribed and what happens, then there's a good chance that we are only getting carried away by what data we are getting and not any information on what the company is actually doing. So this is why we have to like analyze this part of it very carefully. So we can go to the next slide, sir. Yeah. So now we spoke about the 63 companies which got listed. So we can see that many companies got listed at premiums. And here we have to see what happened to many of them post-listing. So on the left side of the screen, if you see, there are about 63 companies, which part of the listing gains that they fall into. So only one company was had a loss on listing of 20%. 4 companies around 20, 4 companies in the other next range, and so on. So if you see, largely what has happened here is most of the companies, we can say that, have gained on listing. So which is around 35 plus 9, 44 companies have got a positive listing. So this is what has happened. And now post that, what has happened is this 28 companies which have gained about more than 20%. And next is, once the listing is done, post the listing, there are companies, what happens is, now we have seen this time frame that we are seeing is companies which got listed from starting of January 2021 till the end of the year. So what happened to the company's stock price post listing from the day of listing till the current price? So many of them have fallen below their listing price, which means most of the companies here have lost on the listing gains that they have made. So to make a better understanding of this, if we can see, there are 18 companies which are right now trading above their listing price, which means 45 companies are now trading below their listing price only. So a lot of people who initially thought in the first set of this slide that they would have made a lot of money on listing, they have missed out on listing. People will tend to go and buy on the day of the listing. The pricing will be higher. Now what happens here is, it's better to realize that we can't get a good understanding of whether that price is fair or not unless we have a good understanding of the industry. So many of the companies that got listed last year, there is very limited comparative data for us to tell whether this pricing for this company it's good or not. Does this industry have big potential or not? So a lot of cases, the valuations are based on what the growth ability for these companies are, and their earnings or profitability is usually not great. So many of the bigger names, that's what has happened. I don't want to get into the specifics of names because the objective is to make people understand that we have to look at companies where we feel there's a good chance that they will perform well financially and they'll earn profits, because end of the day, all the valuations for them to sustain at higher levels or whatever level suitable for that company, the company has to deliver. So here what we are doing is this last set of companies where the listing price and current price, where they moved more than 20, like they are still trading at 20% higher than their listing price. We want to again look at these companies and understand where they've moved. So they got listed at a price which was higher than their listing price, and today they are trading more than 20% above their listing price. So now it again looks like, okay, now if we waited for some time, maybe we can make a good amount of money on these companies. So now we'll verify if that is true or not. So, sir, can we move to the next slides? Yeah. So these are the 10 companies that we saw in the previous slide, which fit into the companies where they've moved more than 20%. So in all these cases, if we can notice the right extreme, we can see what is the change from the 52-week high. So the 52-week high for these companies is way above where they're trading right now. So what has happened essentially is these companies which got listed at a premium, there was a lot of buying interest in the market. And when there's so much buying interest, people continuously keep increasing the prices. So if institutional investors keep buying, then the prices go up because there is less supply of the stock. And like what has happened is in the last 2-3 months, there has been a lot of changes in the global liquidity. And because of that, again, what has happened is many of these companies who have bought these companies on listing and made good money, they've started exiting, which is why if you notice in the last 1 or 2 months, many of the bigger names which saw huge listing gains have started falling sharply. Now, why is this happening? Now, there are 2 sets of people in the participation. One is people who have managed to get some allotment in the IPO. The other set is people who have not got allotment in the IPO. So when people don't get the allotment, they try to buy at every opportunity that they can get, starting with the first day of the issue. There's a common belief that IPO is a great time to like buy the stock because it's available at the cheapest possible price. But historically, this is not true because less than about 10% of companies actually never touch their issue price. Many of them, like 90% of the companies, end up trading below their listing price at least once. This is true for over the last decade. This is not only for the last year. So this is something that people should realize. And one more thing is we have to also understand why there's so much hype about this company. What is happening for people to like buy at this higher price? So it's better for us to have some kind of understanding about these companies and then decide whether even at a price where there's a gain on the listing price, does it make good economic sense to buy this company's securities or not? So can we go to the next slide? Okay. So now we can look at the types of issue. Now, types of issues that happen, like broadly, now what is happening? That is the recent listing. What's happened is many companies come up with a combination of 2 things in the issue. So some companies issue like a exit route for the promoters, and they have only an offer for sale component, and they also have a fresh issue. So the difference is offer for sale, the persons who have already invested in the company, which is usually the promoters or venture capitalists, they get an exit through the IPO. And other than that, the company is also getting some fresh funds from the public issue. This fresh issue that's happening, new shares are issued to the public over and above the shares that are existing in the company. And the money that is received on those shares comes into the company's financial statements. However, when an offer for sale happens, it is actually a transaction which is being conducted at arm's length. However, the money goes to the promoter and not to the company. So now there are principally there are 2 things that have to be done here. One is that if an existing shareholder, which in case is the promoters, if they're exiting their they're doing an offer for sale, then what happens is they are actually reducing their interest in the company, because when you feel that you're going to sell a portion of the company shares, which is if it's a fresh issue, then it doesn't dilute the interest in in a slightly different way. But if the shareholder and the promoter, if he is selling it directly on the first day, then it means that there is some reason for them to reduce their stake, which is not very convincing. Another thing is, if the OFS is done, there's no cash flow into the company. Some of the companies which were valued very, very high, there's only an offer for sale happening. There was no issue in public. There's no public issue at all. So in this case, what happens is, one more reason for this is that these companies may be cash rich, where their business has enough cash already because they've previously had many rounds of funding from venture capitalists, or they have good financial, they have a strong balance sheet with respect to cash. Now, I am not against companies where they are doing only offer for sale, but the primary question for that is, it will be better to wait for some time, understand this company, and then invest, instead of rushing to the IPO and buying. Because there's a common thing that people feel that we are missing out on something. It's like there's another fear of missing out happening, saying we should have subscribed for this IPO, we could have made money. But it is rarely true that a lot of people make and sit on huge amount of gains. And there's one more common belief that we will sell it like on the day of the IPO. That will happen to a very small part of people who get the allotment. But a lot of people who don't, they feel like we can buy within the first week and we'll sell within 1 month. So the idea is that they believe that we can somehow exit and sell it at a higher price and give it away to someone. So this idea is not a very practically workable idea, because there's too much uncertainty as to what can happen in such a short span of time. And it's very risky, because there's a good chance that we might get trapped at buying at a higher price, and we may not have the acceptance to tell that, okay, now that the price is reduced, let's exit. Because it's common that we believe that the stock has just got listed, so it will definitely turn neutral, and we might be able to make a gain. So I think we should look at the merits of the company rather than looking at pricing and the excitement that is built around an issue. So we can go to the next slide. So shareholding pattern. So now in one of the earlier slides, I had mentioned about how the shareholding pattern as in how the shares are allotted based on the categories. So now what happens is, on a normal basis, there has to be a minimum issue where the promoters have to sell at least 25%, and based on the size of the issue, that can be lesser, it can be even 10%. But end of the day, there's a condition that promoter shareholding in listed companies cannot go above 75%. So now what happens is, this criteria gets satisfied in the recent cases on the day the listing happens only. But what happens is, there's an allotment that happens on the first day, and the shareholding pattern where there are promoters, then there are financial institutional investors, there are domestic investors, and then there are public, which are retail investors. So now there's a shareholding pattern between these people, where promoters can hold up to say 75%. So the balance 25% is split between the remaining categories. Now here what happens is, company, they're required to disclose this shareholding pattern on a quarterly basis. So what happens is, if we look at the trend with respect to this shareholding pattern, we will actually understand why the qualified institutional buyers have actually participated in this IPO. Because in some cases, what happens is, qualified institutional buyers have a lock-in period. They have to hold the securities for at least 30 days. So what happens in the first month of listing is, there is no selling of qualified institutional buyer shares. However, other qualified institutional buyers who didn't get any allotment, like in the IPO that they applied, they will buy on the first day, they will buy on the second day, and they will hold, because they might have the view that even at this price, the valuation seems fair, and they might hold it, or they might buy for holding it for 1 week or 10 days, and they might also sell. This opportunity is also there. So now what happens is, 30 days is what the SEBI regulation is for QIBs to hold this shares. So many companies which have had either a good debut or even if they've had a bad debut, 30th day when that lock-in period is closed, many of these QIBs rush to exit. And when this happens, the stocks lose a lot of money, as in the valuation gets affected a lot because they all correct sharply, like at least like 5 to 10%. And if you're a retail investor who's bought the shares, like post the issue has happened, then there's a good chance that you're starting to lose money at that time and you don't know what really happened, why the stock price went down suddenly. So now SEBI had done this 30-day lock-in period to make sure that issues that happen, there's a price discovery mechanism in the first 30 days. Because if they allow QIBs to sell on the first day, then it's going to make companies which are not doing well, the stocks will get hit very badly and they will correct very sharply. So this 30-day window is basically like a price discovery mechanism on the market that the regulator is trying to do. Now, one more thing that the regulators have now realized is this 30-day window doesn't seem to be sufficient, because many cases the retail investors are suffering because these bigger names tend to exit and the retail investors end up getting trapped. So now they are coming with a draft. They've given a draft guideline, and this is going to come effective from April 2022, where only 50% of their initial of the QIB portion can be exited after 30 days, and the remaining 50% has to be held on up to at least 90 days of listing. So this is to make sure that again that these people don't quickly dispose on the 30th, 31st or 32nd day. This flipping of shares is a very common thing and it's been noticed by people at large. But the thing is, it's better to stay away when you feel there's like too much hype about some stock. If there's a genuine case where the company is profitable and there seems to be a good potential in that company, then it makes sense to at least stay invested in that company. On the other hand, if you're just like feeling that this company will do very well, but today it's not doing anything, then I think we can wait to get some more evidence about the same instead of just blindly believing that something good will happen in this company. So, sir, we can go to the next slide. So here there are two cases that I'm trying to show. One, the change in shareholding pattern in two companies. So in the first case, what has happened is the listing has happened in March, and the initial shareholding, if you see, it's 75, then 15 and 10. This is more or less the ratio at which the allotment was done. So if you see here, this case, the company is probably a loss-making company because the retail size of the issue is only 10% and their shareholding is only 10%. Now, if you notice this March and June, between this in sometime between this 30-day window will be over. So when that 30-day window is over, the institutional investors have started selling, which is why the public shareholding has gone up from 10% to 18%. And going forward, that trend is just continuing. And basically, FIIs who had 15% in the starting are having only 3% by the end of December. So why FIIs or DIA holding is important. Now, when FIIs and DIAs hold the shares, the amount of liquidity of the stock is less. That is one thing. Another thing is, when they are holding on to the stock, the general belief is that they have put in way more money than the normal people have. So when that is the case, they will hold on to the stocks only if they genuinely believe that the company is going to do well. If they feel that the company is not going to do well, they will just walk away with listing gains and they'll start they'll start trimming the positions, and basically retail investors will come in at much higher prices and they will not have to get a fair reason as to why they are losing money, because basically they won't know what hit them. That's what will happen. And now the second case, where we can see promoters holding was 70% in March, and in December again it is 70%. Here what has happened, if you notice, the shareholding pattern is more or less the same. The FIIs and DIIs, there's a small change between the two, between the time frame, And that is basically some amount of investments has moved from one category to the other category. However, the public participation is largely the same. In fact, at some point of time, it has gone down a bit, and then it's come back to a pretty much the same level. So now again here, what general view that I would say is, now this public shareholding, it's at 11%, which is fine. It can go up a little bit. It can go like 2-3%. That's fine over time, which is pretty normal. But if the shareholding is going up very rapidly, like from 10 to 20 in about 8 or 9 months, then that's not a good sign, because institutional investors get so much more understanding of the business. If they are not holding on to a business, and if they're not holding on to the shares of a business, then that definitely means that they were in the game in the starting only for the listing gains. So once that's done, they are just exiting. That's why it's better to wait out at least till the 30th. If you don't get an allotment, just wait for the 30-day period to get over. Once that happens, you will actually be able to appreciate what's happening with respect to that particular stock, because if there is interest, the shareholding of these people who got initially will not reduce. They will hold on to the stocks that they've purchased. In fact, when those people hold on, the demand will again go up because there is no supply. On the other hand, if on the 30th, once the 30-day window is done, if the people start selling, you will realize that the supply is so much higher than the demand and the stock starts to tank. So we can go to the next slides. So what are we trying to do? Like some of the key things that we have to look is pricing, about what happens with the issue. These are things which are slightly quantitative, but we have to look at some qualitative factors also when we are trying to invest. So key thing that we have to look at is, what is the reputation of the management? And if there's a brand that we know, then what is the image of that brand? Is there any value in that brand? So management based investing is a very, very common way of investing. Like if you feel that this the promoter of this company has a good strong record, then you can kind of be confident about investing in that company, because stock prices, the corrections that will happen irrespective of how good the company is. But what we are actually trying to understand is, from a business perspective, how well is this company doing, and is this company being run by people who have the ability to run it well. So the DRHP has a lot of information about the management. You have details about what is the educational qualification of them, what are the associated entities that they've worked with previously, what is the experience they come in with, and also it gives other details like, if the organization that's the company that's getting listed, what are the related parties that are there for this particular company, what is the quantum of related party transactions that are happening. And it also gives data about the records, like if there are any criminal liabilities or records of the either the company or the promoters, directors, and it helps us identify some red flags. Now, these red flags are very useful at the DRHP level, because at the prospectus, which is the DRHP, it is mandatory for companies to disclose a lot of information, which is available only as of that date again, because subsequently a lot of things may not get covered on the public information forum, but as on the date of the issue, anything that is there in the with respect to the company or the management, they get captured. So that's why it's important that we look at this. So now below here, there's another company where I've just shown what the shareholding pattern was. So here what has happened is they got listed in 2019. At that time, the regulation was that based on the size of the issue size is very high, then the 75% shareholding criteria was not applicable to companies, because the issue size is very high. So it's difficult for a company to issue shares for so much. So over the period of time, what happened was SEBI came up with a criteria, like a condition, that any company which got itself listed has to bring down the promoter shareholding to 75% over time. So in this case, what has happened is the company has trimmed its promoter shareholding some from say about like March only, and then it has made sure that it stays there. But here again, if you see, one more point I'm trying to highlight is, look at the change in the institutional holding and the public shareholding. Public shareholding was 9.68% previously. And over time, if you notice, it is kind of pretty much only there. It moves a little bit here or there, but it's pretty much only there. Now, in the case of this company, the institutional investors are very, very comfortable with what the company is doing, which is why on the first day they had only about 9%, but today they have over 15 to 16, 15.5, 16% they have as the investment, which means they've actually like triple the amount of shares that they have in this company. Now, this in hindsight, it's very easy for me to tell that if you look at this company, see what is happening. So you can also like find this. Now, if you look up the company in this particular case, the stock price would have gone up nicely because by now the supply in the stock will be very limited. So naturally, like people will keep buying the stock at any high price. Now we can just wait for 1 quarter at least, like wait for the issue to happen and then wait for the 30-day window to get over and wait for 1 quarter. Now you will see what is the actual change in the shareholding. And at that time, say if you're convinced about the price, then you can start buying a little bit. Say if you have like a percentage of your capital that you want to put in, say if you want to put in 10,000 rupees, buy for 2,000-3,000 rupees, wait for the next quarter and see the results come in. Now you have time again. Now by this time you are 6 months into the listing once the listing is done. So by this time, this shareholding related changes are largely done, because going forward, nobody is looking at 30-day windows or anything. Somebody who wanted to exit has already exited by now. And if people have strong conviction about this company, then they have basically increased their investment in this company. So this is why waiting it out a little bit is better, because we already saw previously that many companies which got listing gains end up trading much below their listing price. And also even companies which continue to like do well, there is a lot of movement and they tend to keep having like corrections sharply. So I'm not saying don't apply for IPOs as such or anything. The point that I'm trying to drive here is very simple. If you don't get an allotment in an IPO, then please wait it out for a bit, because there's a good chance that you will make more money if you wait and invest in a company, because every company that is investable today, one day it was an IPO company only. So you just have to wait for the right time to buy the company. So we can go to the next slide. So companies' guidance and objectives and utilization of IPO proceeds. So objects of the offer. So when the company is filing the draft red herring prospectus, it mentions about the size of the issue, how is the allotment going to be done, and all of that has happened. So one of the key things that they mention is this will happen only in cases where there's a fresh issue. In an offer for sale, this objects of the offer will not be there. But in the fresh issue that happens, companies can utilize this money for different things. If it's a manufacturing entity, they want to set up a new factory, or they want to do more capital expenditure where they can increase their capacity, or some cases the companies want to enter a new business vertical where they want to move on the previous stage of the companies. Like say they're doing a manufacturing of some automobile part, they'll try to acquire or start a business which is one line below or one line above. They want to do the sales to the market by themselves. They don't want to go through a sales channel where there's another intermediary. So this is one more possible reason why they can do an issue, because they want to collect money and they want to establish that part of the business on their own. So they can do a backward or forward integration. Another thing is debt reduction. This is a very, very, very common thing, because for many companies, when the debt equity is like is very high, then companies feel that if they can raise money from the public market and repay debts, then the debt component of it frees up a lot of money for the company, and they are able to do their business much better. Another thing is geographical expansion. Some companies try to like make sure that they want to go pan India. They are not restricted to one region because of two reasons. One is they feel that the particular business they're in can be done in like a much more broader manner than the level they are doing or scale that they are doing it. And another thing is you don't want to geographically concentrate yourself where you're there only in one part of a country or where your revenues depend only on one region or something. So these are some of the common reasons why people like try to get themselves listed. And another thing is based on the industry, the objective of the IPO is different. Cash rich companies usually will not have this requirement only. They will just raise money for general working capital purposes or something like that. But companies which want to expand, where they need to put in a lot of money, which they don't have, like say they have only one factory, but they feel that their business, they can set up 3-4 factories. Then they will raise money from the public and then they will try to come up with areas where they can actually like invest and basically they are all working towards increasing the wealth of the company. So that can be done only by expanding. Like a same factory can only produce so much of capacity. So they are trying to ensure that they can add other regions and make it more meaningful. Now, one more thing that I want to talk about is there's a lot of things that are coming up about companies like postponing IPOs recently because they're all like they've seen a large correction in the last 2-3 weeks and they feel that the market may not treat these companies correctly, which is true because if you look at some of the companies which wanted to get themselves listed in March 2020 or something, some of them got listed and they got like discounted, like they basically traded much lower than their issue price. And many cases what happens is it's not a favorable time because investors in general are very scared and nobody is willing to buy stocks even at good times. So now this has to be addressed by doing only one thing. It's better to look at what the company is doing, understand the business, and then finally take a call based on the valuation. Sometimes companies can come in at very, very low valuations. And this way, we have to make sure that we find a chance to buy these companies at the right price. Like one of the IPOs in the recent years that came in at a very, very low price was the IRCTC IPO. I think it's slightly old now, but still at that time, it was a very good opportunity, but a lot of people were not aware. I belong to one of the people who was not aware as well. But the thing is, we have to make sure that we find good opportunities and buy them because sometimes a lot of companies which are successful may not get so much public attention, but the financial statements of that company, the ability to perform will speak for the company's pricing and the valuations will go up once a lot of people see that there's merit in investing in this company. So this is what I've tried to cover. And broadly, if there are any questions or something, you can please go ahead with the questions.
Yes, sir. We'll stop this and start sharing the questions on.
I will share the screen from my end.
Please.
Is my screen visible, sir?
Yeah, it's visible.
So you'll be taking up the questions, or else do you want to?
Yeah, I can just take up the question. Okay, the first question they said, elucidate about the proposed LIC public offer. Okay, so the first thing is this offer by itself, it's very big. And to be very honest, we've not seen any offer of this size. So as an investor, to tell what has to be done with respect to this company, we have to wait to get sufficient data on this company. One of the key data that we need to get with respect to this company is what is the valuation that they're planning to list at. That has to come out, and only based on that we can tell. But to just give some general idea about what LIC is doing, are they doing well or not? I think we have to look at a comparison of what is their growth rate versus the rest of the companies that are in that industry. So I believe that in general, despite them having a lot of market share over the last 3-4 years at least, they have been losing a lot of market share. So that is something people have to understand why this is happening, and whether it's still not a cause of concern because individually they are still growing or not. So this is one thing. And with respect to profitability, I don't think they're highly profitable. Many of the companies which are much smaller in size are way more profitable. So again, I'm talking in percentage terms and not in absolute terms. LIC is a very, very big company, and the other companies, maybe most of them even put together, will not add up to the size of LIC. But the real thing is, it has to be a individual person's view whether you are convinced with what they're doing or not. As a brand, LIC is very strong, and it's one of the flagship companies that has been there, and they have very strong investing capabilities. Like they have invested in a lot of listed companies and all. But from a business perspective, their actual strength is the number of agents that they have, and the insurance business as such, the number of agents that are there on field is very high, and they are very open to get more agents on field. There is no restriction as such with respect to what qualification that they need to have and all of that. So that way, the business is very, like, they have a large distribution network. The only thing is, we have to look at whether the valuations that they're coming in is a right way of looking, is right or not. The other thing that's going to happen in this case is a lot of things have changed with respect to the foreign institutional investors coming in. So this particular issue is a very interesting issue with respect to how things will go ahead. But it's very difficult to tell without having sufficient inputs on the valuation as to whether we can buy this share, as in buy or subscribe at this price or not. I don't really have a view as of today. So it's better if we just try to understand the business better before we make a investment decision. So the next question is, what are the benefits of subscribing to pre-IPO offer for retail investors? So one of the general benefits for this pre-IPO offer for retail investors is you are trying to give existing policy holders an option to invest. So many people here who come in as non-policy holders and who are retail investors will have to compete and get their shares allotment happening. But if you are there as a policy holder, then the number of people that are there who are actually policy holders, who are also investors, will be lesser than the number of people who are applying on the normal scale. So you have lesser competition. That is the actual advantage that you will have. And one more thing is, even in normally for retail investors, when issue is being done, post the number of subscription, if it's oversubscribed, then the method of allotment is it's based on a random basis. Like it's basically like a lottery, and that is how the allotment happens. So here the number of people that your odds are better in getting an allotment. That is how it will actually help. And I think they might give some small discount. I'm not sure of it, but they might give some small discount for the people who are coming through as policy holders. The next question is, can Indian companies get anchor investors prior to IPO? Okay, so anchor investors, who are QIBs, they are actually companies who are necessary for the issue to go through. Like an institution can come in as an anchor investor during the IPO, but before that, any institution can actually invest in that company. There is no restriction. Like a lot of private companies, as in public limited companies, but which are yet to be listed, they will have some venture capital firm. Many of the bigger names from outside India or within India, many of them invest. So they can already be investors in the company, and subsequently also the anchor investors and the investors who are existing, they can be like both can coexist. So there are no issues with respect to that. Next question is, for companies without track record for profit, what are the additional steps to be followed to get approval for IPO? Okay, so with respect to companies who don't have track record for IPO, the regulation changes with respect to the allotment. That is the breakup, where if you are a company without a track record, then the QIB portion increases. The QIB portion becomes 75%. The non-institutional investors becomes 15%, and that of the retail investors is only 10%. So here what happens is, for a QIB company, QIB investors to invest in this company, they should actually find something in this company. This is one of the primary reasons where this condition only came in, because QIBs are mutual funds, insurance companies, foreign institutional investors, domestic institutional investors. So these people have a good understanding of businesses. They will put in money only if they feel that this company is good. So many times, if the company is not good, if they feel that this company is not going to do well, then the issue only may not get through. Like the issue may not happen. But the problem that has been there of late is, we have not seen any company where the issue has stopped. But the reason for this is the liquidity currently is very high, which is why any issue, it definitely goes through, as in the required amount of subscription happens, because there's surplus amount of liquidity in the market. So that is the reason why this is currently happening. But eventually sanity will prevail, and when this liquidity, which is very high, it goes down, companies based on their merit will get subscription or they won't get subscription. So next is the fifth question. When the company is going good, why promoters go for OFS? Is it correct to understand that they are not sure of the company's prospects or growth in future? So now there are two possible reasons why when company is going good, why promoters can go for an OFS. One is they want to cash out some money for themselves. So say they are the ones who have been in the company from day one, or at least for most part of the journey of the company. And today they feel that this is a good amount of valuation for us to exit some part of our investments. So this is one possible reason why the promoters can go for OFS. Another thing is, many of these promoters, they are usually like not invested only in one company. They try to invest in multiple companies. So they might have a requirement where they want to start a new company, which is usually not in a direct competitive business. It's in some other industry. So that could be one more reason why they're like selling and trying to make money out of it. So usually these are the primary reasons why offer for sale can be done. Whether it is good or not, it is actually based on the reason only you can tell. In some cases, if the management doesn't have a good reputation, then an offer for sale is an indication that something is not right in the company, which will eventually come out. But because they know it beforehand, they are exiting much earlier. Then, does the RHP contain financial projections or the projected business plan? If not, why SEBI is not insisting on it? So I'll just answer that first. So RHP does not contain financial projections. Generally, you are not allowed to give financial projections as companies, because first thing is, there's uncertainty and it is misleading. A company which is doing extremely well, it will obviously show that it is going to do well. A company which is not doing well will show a turnaround if there's going to be a possibility where projections can be shown. This is why SEBI prohibits financial projections of any thing. And SEBI is not insisting on it because SEBI doesn't want them to give you any forward-looking statements, because these are all very difficult to actually achieve. And to go to the second part of your question, these days companies are charging a huge premium, even in case of loss-making companies. Should not SEBI take a more conservative approach in sanctioning the issues in such cases, especially if future financial projections are not? So SEBI is also thinking exactly like what you are thinking right now. So what SEBI has done recently is they are trying to tighten the measures for companies which are loss-making and which are also getting listed. They want those companies to give some metrics which are relevant for those particular industries and give the public more data, because financial statements alone for these companies makes little to no sense, because some of the companies which have a lot of capital, which have huge valuation, will be bleeding financially. They'll be burning a lot of money every quarter, and these companies definitely have to improve on their disclosures. So unless this happens, it's going to be difficult for investors to actually understand whether it's worthwhile to invest in this company or not, because sometimes the operating metrics can be favorable for the company, and that will give you more confidence as an investor, and there's a good chance that based on that people will decide to invest or not. So that is one thing what SEBI is trying to do. Next question is, does the merchant banker has any say in fixing the issue price? Okay, so there are principally the objective of the merchant banker will be to increase the valuation in some way. But another thing is, the merchant banker is also going to try to find a price which the market will accept. So if the pricing is very high, then the issue might go through, but post listing, people are not going to be happy with that valuation, and a lot of people will basically start reducing the value of the stock of that company. This has been the case always. Like some companies, the issue price is very high because the comparative that they take is another company which is there in the same segment, and they tell that this company is trading at this multiple, so we will list this company also at this multiple. But both companies cannot be compared, because unless their business is too similar and the kind of volume and revenue that they're doing is same, this valuation is not justifiable. So merchant banker can come up with some fancy fixed price, but end of the day, market will treat it with respect and give it the position wherever it belongs. So next question is, in the recent times, whoever comes IPOs, the valuations are on higher side, and merchant bankers are ruthless in promoting the issues, and retail investors are most badly hit. CCI regime good to control this high valuations for IPOs. What is your opinion? Okay, so I didn't understand your last part as to what CCI regime good control means, but the valuations are on higher side and are ruthless in promoting issues, and investors are mostly hit. See, the problem is again that the merchant bankers or even the people who are making the market, they work on a basis of commission, which is on the percentage of capital raised. So ideally, every person who's a merchant banker to the issue, the higher the amount of the valuation is, their consideration is more, because they have vested interest in it. But end of the day, whether they are going to make that much money or not, you can decide for yourself as to what you want to do. And retail investors are going to get only a very small portion of the issue. So it's better if retail investors reduce their amount of investment. So instead of, you can either skip the IPO and wait, or you can put in lesser money, which way you are more conservative. If you make money, you make little money. If you lose money, you lose little money. Instead of putting in more money and expecting it to do like extremely well or get disappointed, you can just be conservative and wait for the theme to play out. So next question is there a market making mechanism in place for IPOs? Can you elaborate on this, please, and how it works, and if investor can benefit from it? So actually, for the QIB levels, this market making mechanism is there. What happens is they have a price discovery that's being done, and based on that is they make the QIBs, who are again the domestic foreign insurance companies and all, participate. They will bid for shares. They'll do a mock bidding, and based on this mock bidding, they arrive at a price and a valuation, and all of that is done. And that is one way where the merchant banker is actually able to estimate what is the reasonable valuation that these people will pay, because anchors are the ones who have to actually invest the money first. They actually get the allotment one day before the public issue is open. So that is the mechanism for the price discovery. So this is what happens. How an investor can benefit from it? Actually, we can't tell what exactly happens there, because with respect to the QIB portion, I don't think we get data of the uh, overall bid and all of that. I'm not very sure of that, but I think usually QIB interest will be higher because they have more capital, and QIBs have also, like, even in QIBs, it's not like every QIB is very good. Some of them are below average, some of them are above average. So the perspective of people changes. It's just that they have more money and they are also bullish. Someone with lesser money can also be bullish. So next question is, when inflation is increasing, can we do a startup like developing country India? Startup idea is automobiles industry and how to collect capital. Okay. So I don't know how both are actually linked with respect to startups and your own idea. But see, generally, every business has its own cyclical opportunities. Automobile sector, like 3-4 years back, until then it was doing really well. Last 3-4 years, it has been doing pretty badly. So it depends on what part of the business that you're trying to do. So to be able to like figure out what business you want, that's all up to you. And how to collect capital, again, it's a very subjective question because I don't know what scale you're looking at. So this question is very vague. So I'm not able to give you a genuine answer. So next thing is, how can we see stock splits? Is it positive or negative in the retail investor point of view? Okay, so now I'll put it in a way where it's very simple. We have an apple, we are just chopping it into 8 pieces. We still have only one apple. So we can say that in the first case and in the second case, I have the same amount of assets. There's actually no change. Theoretically, there is no change at all. One of the reasons why companies do stock splits is they want to improve the liquidity of the shares, because if the amount of liquidity in the shares is less, then they feel that we can split the stocks. That is one of the common reasons. And another thing is, if the price of the share is very high, then not everybody will be able to trade in those shares. So that is the reason why companies can do stock splits. But from an earnings perspective, there's no dilution to the shareholder or there's no appreciation. So a stock split is not, it actually has no great significance. It is only purely a book-based act. There's no meaningful thing that we can understand from it. Say, I go to the next question. Since ongoing valuations are on higher side, please explain simple method to check the same from draft prospectus. Okay. So now what happens is, say the company is coming for a public issue, you will get what is going to be the market cap of the company based on the issue. So now you can take, I will give it with an example only so that you can go and have a look at it. Now you take a FMCG company, say it's going to get listed. Now you look at the price earnings ratio for this company if it's going to get listed tomorrow. You can take the price earnings ratio, and based on that, you can determine what is the, hello?
You can continue, sir. Audible.
Yeah. So based on the price earnings ratio, you can compare it with other companies which are in the same business and see if this valuation is reasonable or not. So usually how the valuation differences happen is, now in one company, in one industry, if there are about 7-8 companies, 1 or 2 companies have high market share and are market leaders. Then there are like 3 to 4 companies which are doing average. 1 or 2 companies are doing way below average. This is roughly how the distribution happens. So when this kind of distribution is there, the companies which are market leaders, they have better profitability because their ability to take price increases is very high, and their margins are also much superior to the normal companies. And one more thing is, by scale also they are higher, like their revenue is much more. So that way they are more efficient with capital that they have. This is the first case. Now these kind of companies are given the highest PE multiple. Then the average companies, their PE multiple usually like between the lowest and the highest guys. So it's somewhere in between. And here what really happens is, sometimes they are not able to scale up. They have grown well from a small company to a middle-sized company, but beyond that middle-sized company, they are not able to grow. This is one possibility. Another thing is the target audience that that company is trying to reach out to is different from the premium player. Premium player or the market leader always has a much better customer base than the guy who's in the middle tier. And then the last, which is the bottom strata. The bottom strata, usually what happens is these companies are more of a hit or miss kind of companies. They either do extremely well or they don't do well at all. And these kind of companies, basically the management quality is okay. The business risk is very high because they have a lot of factors which they are not able to control or anticipate correctly. Like the demand, they are not able to forecast correctly, or they have a inventory problem, or they have a working capital problem. So these kind of issues are there. And this is these are just examples. This list of causes of concerns can be exhaustive. So there can be so many reasons why that company is not doing that. So these are the kind of things you can look at in that company, and you can look at as comparative. Like most of the cases, there will be a comparative which is already listed, and that is the better way to compare. So please don't compare a company which is going to get listed with an unlisted company, because the valuations will be very misleading. So you can stick to companies which have come to the market, have had that price discovery opportunity, and then you'll be able to appreciate whether this company is priced correctly or not. Okay, next is, can you guide on whether trading or long-term investment in stocks is better? These are all personal decisions, so I don't want to tell which is better, because if you are going to be a full-time trader, I can't tell you go and do long-term investing. So that depends on what your professional choices are. So that you have to stick to that. Next thing is, similar to the SIP in mutual fund, does SIP in stocks work out? So first thing is, SIP in stocks is equally good as SIP in mutual funds, provided you have good understanding of the company that you're doing an SIP. So why your SIP in stocks is good, why it is bad with compared to mutual funds, I'll tell. In an SIP mutual fund, your duty or role is done with you making that payment. You don't have to think about capital allocation. A fund manager is full-time doing the work of capital allocations. He is paid to do that. You are paying him for that. And he will make sure that he is trying to allocate the money that you've given in a good way. The only thing is that towards the other side, where you are doing SIP in stocks, you should be able to track that company continuously. And if you're able to do that, there's a good chance that you will make that investment will be a favorable investment for you. On the other hand, if you are not able to track the company continuously, then it's better to rely on a fund manager than to actually go and invest in stocks on a monthly basis by yourself, because that person definitely spends more time on companies than you possibly will. So given that that student is more prepared than you are, he will do better than you are, the chances are very high. And another thing is whether investment in ITC is a good buy, being a multi-bagger. So these are all very difficult questions to answer. I'll tell you why. Because many companies have periods where the stocks don't perform well, and this period can be very long. This period can be as long as 10 years. The best example for this is Reliance Industries. If you see Reliance Industries, for about 7-8 years, it was pretty much at the same period, same kind of valuation. There was no major movement. And suddenly the value of the company shot up like anything in a very short span of time. And then there are a company like HUL, which was also facing whatever ITC is facing today. It was having very, very, very average valuations, and it was constantly not getting any capital appreciation. So one more thing is, based on these two examples, I'm not going to tell you that it's good to buy in ITC. What I'm trying to say is, as a company, see what they're doing. Have they changed anything? For them to have not done well in 5 years, it means that the company has structurally maybe not done enough in last 5 years. So unless some new information comes in, I don't know if there's anything that we can tell based on the existing information that the company is going to do well, because large part of their revenue and profits right now come from the cigarettes business. So you have to convince yourself as to what part of the company excites you and why you're going to invest. If you are able to like convince yourself on that, then you can do that. And you have also asked that suggest some good stocks based on your view. I don't want to get into names, but I'll tell you where you can find or how you can find good stocks. Go to the Nifty 50. Pretty much the best of stocks that are available. Make sure you buy them at valuations that are reasonable, because Nifty 50 companies are in some way or the other the top 50 companies that are there in the index. So they are going to be companies which have some kind of track record or who have done like a good amount of work in general over a period of time. So that is where you can actually find some very good stocks. Other than that, to find good stocks, you need to spend more time to figure out. There can be very good companies even with lower market capitalization. It's not like only bigger companies have to do well, because every company which is big today was a middle or small company at some point of time. So you can always like find opportunities at different levels. The Nifty 50, why I'm saying it's a good place for you to find is the fact that it's made it to top 50 itself. It has kind of won a lot of competitors. So that is why it's a good place for you to figure out. Next question is, what key performance indicators and non-GAAP measures are appropriate while analyzing an IPO? Okay, key performance indicators. These key performance indicators will change based on the industry. Now I will give an example with respect to your technology companies. Now say we look at a delivery company. Like I'll just give a name only, it's fine. You can go and see what they're doing. In case of Zomato, if you can see, what is the average order value that is happening? What is the average customer retention? These are the kind of examples like of what indicators that you can look at, because industry specific, you have to see what is happening. So in case of other which are product companies, like Zomato is a service company, it's not a product company. If you look at a product company, see what is the customer acquisition cost of that company. They will mention this on their presentation. It will definitely be there even in the red herring prospectus. And these are the kind of specifics that you can look at to figure out whether the company is doing well or not. In general, companies which is not doing anything fancy, look at the margin profile. See what is the gross margin like. See what the EBITDA margin is like. Compare it with another set of companies, like 4 or 5 companies that are there, and try to figure out whether this company is actually doing well or not. Is it having a better gross margin compared to the other companies? Or at an EBITDA level, what is happening? Because below the EBITDA level, companies, based on their scale, it will change. Because company has debt, then the profit, obviously the PAT margin will be different. But at an EBITDA level, the comparison is somewhat fair, because you're looking at only the operating ability of that company and not the financial leverage what is happening. So if you can look at that, you will be able to understand which is doing better. So that will be a good way for you to figure out whether this companies you can invest or not. What is the procedure followed in allotment process for applications under HNI? If one would like to have allotment of shares in IPO, is it worth trying in HNI category? Please elaborate. Okay. So the first thing is, procedure wise, you have to be a HNI first for you to be able to do it. So I think if you're a HNI, you can actually reach out to people like a proper stockbroker or someone, and they will actually help you out with it. Because I don't know if you can actually apply in the HNI route without being a HNI. I'm not too sure of that. So it's better to actually go and contact a stockbroker. How the allotment happens is that it's again proportionate allotment only. So if the HNI portion is 100 shares, and if there are oversubscription by 100 times, then the allotment is done as on a pro rata basis. So you'll only get 1 share for every 100 shares you had applied for. So that is how the allotment happens. And procedure wise, there are some differences, of course, but broadly, you have to give money and they're going to help you with the allotment. I don't think there's anything major that's going to happen. Yeah, I guess I'm done. The Q&A is also done.
Those are the questions. And also over to you.
Yes, Mr. Srinivasan, it's a great job, sir, from your side, and the number of queries goes to show that how your presentation is impacted on learning various aspects of IPOs. And this initiative, I am again stressing to the members that it is an initiative of the Ministry of Corporate Affairs of India, Union Government, which they have suggested us to do it. There's a financial literacy program and what's called upskilling the financial knowledge, all these things. So we have been doing on monthly basis, and this today around 1,000 was the registration, and more than 350, 400 are there till the end. So it's a great presentation, and a big thank you on behalf of the SIRC to Mr. Srinivasan, and we'll be in touch with you for the programs also.
Thank you so much for.
Yes. So I must thank all the participants, but for whose presence or encouragement these programs would never happen. I thank each one of the participants for their registration and participation here, and in making such programs successful to energize us to take forward such programs in the future too. Thank you one and all the members. And I thank in absentia our chairman, Mr. Srinivasan Talakaila, and the secretary Naresh Kelly, who could not make it to this program because of the travel plans. And this is a program coined by our chairman and CP committee. I thank both of them. And also, last and very importantly, I thank Mr. Selva, the technical support for this program, and the back office of SIRC for making this program very useful, purposeful, and successful. Thank you, one and all.
Thank you so much, sir. Thank you for the opportunity, and I thank the institute for hosting such programs, because
Yes.
It gives us an opportunity to learn things where on a normal basis we won't have a platform for. So I'm very happy that this is happening on a regular basis, and I thank all the participants, because without their participation, any effort that we put in will become meaningless. So I'm really glad that people are interested in learning more. So it's a good thing for me to take from this.
Thank you. We'll be in touch with you, and we'll call on you for the future programs.
Sure, sir. Thank you.
Thank you.